Hello, Andrew Myers from Intuitive Finance. I hope you're well. Welcome to the new year of 2018. All the story seems to be about rising interest rates. When are they going to go up? How much are they going to go up by? The long-term average for interest rates is actually 7.25%, set by the Reserve Bank of Australia. Currently, we've been experiencing for about the last 18 months, record low rates at 1.5%. Now the banks, you have a margin still on top of that. So we're all paying somewhere between the high threes and then the low fives, depending on whether you've got a home loan, you're paying principal and interest, or an investment loan and interest only. There's a whole lot of factors that go into now your interest rate. So how do we protect ourselves from the potential risk of rising interest rates? Well, the first thing I would strongly recommend, anyone with a home loan, I believe you should be paying principal and interest. You'll get the best rate by doing so. The secret to this is then, if you've got a rate of, let's say, 3.9%, 4%, start paying it as if your rate's 5 or 6 or 7%. There'll be a few things that happen. One, you'll start to build in that buffer into that rate. So if rates do rise, you've already used to and accustomed to paying that. The second thing is, if rates do remain low, you'll start to fast pay your home loan down, and that's the best way to add equity to your property for whatever it might be that you want to do in the future. And finally, by doing that, you'll save potentially thousands, probably hundreds of thousands of interest over the life of the loan by factoring it in at a higher rate now. So I think that's a great strategy for all our homeowners out there. Pay it principal and interest and gear it as if it's paying at a higher, much higher level. It'll give you great certainty and security. The second thing you can do is potentially look at fixing your rates. Now, as a fixed rate, it's not just go out and fix your rate because it has other repercussions. But what you should do, depending specifically on your circumstances, so let's say you're changing jobs or you're starting a family and things like that, and you're going to be losing an income or getting a lower income for some time. It makes sense to give yourself some protection against the risk of rising rates. And that's what a fixed rate does. You lose some other benefits that you might get in a variable rate, but a fixed rate gives you great certainty and security. Also, if you're an investor and you've seen over the last 6 to 12 months your rates slowly creeping up, with the banks changing and being asked by APRA and our regulators to put in certain mechanisms to slow down the lending markets, if you've seen your rates go up, let us know. There's often a fixed rate. You can fix at a cheaper rate than what you've got on a variable rate right now. So that's a great strategy for our investors, either interest only or principal and interest. Locking in some of your debt or some of your portfolio in the current market isn't necessarily a bad thing. But you know what the best probably strategy is? Doing a full review. We actively encourage all of our clients and any new clients, let's do a full review of your portfolio. Let's look at your facilities. Let's see what equity you have available. Let's see what your incomes allow you to do. And then from there, put a strategy in place. As Aussies, we tend to be pretty complacent with how we go about our mortgage and our mortgage rates. First to whinge or slap the banks around when they don't do the right things, but most of the time we just don't take the time to seek out a better deal. If that's of any interest to you, of course, we would love to speak to you all, and I hope there were some handy tips, and we look forward to working with you soon.